Shell has approved a $2 billion final investment decision, FID, for the HI offshore gas project in Nigeria, signaling strong commitment to bolstering its gas portfolio and Nigeria's LNG ambitions. The project, in partnership with Sunlink Energies and Resources, aims to deliver 350 million standard cubic feet of gas per day to Nigeria LNG, expanding capacity and strengthening export potential via the Bonny Island terminal. The HI field, located 50 kilometers offshore, is expected to begin production by decade's end, supporting both export and domestic energy goals. We have Kelvin Emmanuel, CEO Derry Hills, joining us now to provide some perspective. Good morning.
Thank you so much for having me, Joanna. Good morning.
Yes, a pleasure. And obviously, this is a landmark deal and comes, about 40 years after the discovery of the HI gas field in 1985. Some would say it's been a long time coming, and what would you say gave that final nudge and sealed the deal for this FID?
So, as it stands right now, if you look at the export markets for gas, NLNG, which is a joint venture between Shell, Total, Shell owns about 25.6% of NLNG. And the Nigerian government joint venture, Nigeria owns about 49%. So Nigeria is practically the single largest shareholder in that JV. It runs under what they call incorporated joint venture company model. Train 7, is the first train that is going to be built and delivered since at least 2004. It has a total installed capacity of 8 million metric tons, which will bring the total installed capacity for NLNG to 13 million metric tons a year. But the problem, because NLNG has a shortage of gas feedstock, so capacity utilization has been hovering between 60 and 70%, is actually gas feedstock. Gas feedstock, of course, what they call wet gas, when associated gas is drilled, crude oil is drilled, associated gas is trapped. What you see playing right now is what it's called flare gas. And the government has what they call a flare gas commercialization program. So when you drill crude, the gas is either flared, number one, is either reinjected for well optimization, number two, or the gas is trapped and then processed. When you trap the gas, you take it to what they call a designated node for calibration of that gas. Then you take it to a central processing facility, and it becomes lean gas and dry gas feedstock that goes to either the export markets for NLNG, or it goes to the export pipeline through Escravos to West African Gas Pipeline Company. Those are the two ways through which you have the export markets in Nigeria currently. Or it goes to the domestic markets under domestic gas delivery obligations for gas-based industries. So there is a shortage of gas in Nigeria for NLNG. NLNG is going to need about 1 trillion standard cubic feet of natural gas for Train 7. So what this partnership between Sunlink, that owns 60% of the gas, and SNEPCO, the offshore arm of Shell that owns 40% of the gas, does basically is that it will solve about 36% of that shortage for Train 7. But even Train 1 to 6 still has a shortage of about 35% capacity utilization. So there definitely, there is a problem with getting gas feedstock to Train 1 to 6. But Train 7 is going to have the feedstock from H1 OML 144 that is located about 50 kilometers offshore the Niger Delta. So this is a welcome development, because what this does is that they are going to drill 4 non-associated gas wells, NAG. Non-associated gas wells are standalone gas wells offshore that are not gotten by you trapping gas when you drill crude. So up until now, what Nigeria has done mostly, about 7.6 billion scf of natural gas it gets daily, is gas associated with crude. And this has been the conversation and discussion that, look, if you're really going to build your oil and gas sector, and if you're really going to stretch value, you have to focus on standalone gas wells that are non-associated gas that are not attached to drilling crude, which means that your gas output is going to drop anytime your crude oil output drops. So if, for example, there's a drop of 200 or 300,000 barrels of crude, your gas output drops. But what nations have been able to utilize gas, like Qatar, like Australia, like the United States of America has done, is that they've been able to create a petroleum fiscal regime that incentivizes operators to invest heavily in standalone gas wells. You have the Northern power field in Iraq that borders, between Iran and Qatar. That is a major source of gas feedstock for Qatar LNG, and Qatar LNG is close to 100 million metric tons, which is about 6.5 times the capacity of Nigeria's LNG market. So what this will do definitely is that as time goes on and they're able to drill the 4 wells and, pipe the gas to a CPF, and then the condensates will pipe to for processing of natural gas liquids and exports. You see that NLNG Trend 7 will be able to get 35% of the feedstock it needs for its capacity utilization. And you also see that the amount of dividends and taxes the government gets from that incorporated joint venture company model will also increase. So it's a welcome development, but the government should not celebrate too much, because this is just scratching the surface. You need more investments in non-associated gas wells, standalone gas wells that are not attached to drilling crude oil, because you need to accelerate the amount of gas to supply gas-based industries for power generation, for the making of urea. In Dangote, for example, Dangote fertilizer plant, 30 million metric tons, it requires about 650 million standard cubic feet of natural gas daily for full capacity utilization. I'll tell you, currently under the horizontal commercial framework they have between the operators, Nigerian Gas Company and Dangote, that is barely getting up to 70%. So it needs more gas. So in the future, you might see vertical contracts where third parties to operators might be willing to invest in pipeline infrastructure, in building that pipe and drawing gas directly to their GBIs. So you need more gas for both the domestic market and the export market. This is a start, is a step in the right direction. I think with the move of SNEPCO and Sunlink, other operators like Total, the Six Sisters, ExxonMobil, Chevron, will be incentivized any to actually invest. But you need to see more investments. You need to see more non-associated gas wells, especially deep offshore and offshore, to be able to bring in the gas that both the export and domestic market needs. And one of the reasons why this FID was easy to close, 285 billion MMBO in total, but that field holds a potential of over 1.6 trillion standard cubic feet. So what they're doing with these 4 wells is probably anywhere between 20 and 25% of the capacity of the H1 OML 144 field. Is they basically will bring the gas to surface. Sunlink will sell 60%, all 60% of the share of the gas that it owns to SNEPCO or to NLNG, depends on the structure of the contract. Either Sunlink sells it directly to NLNG and negotiates the contract on the gas prices for somewhere around maybe $4 to $6, which is the export parity price per standard cubic feet. Or Sunlink will sell the gas to SNEPCO, and SNEPCO will supply the gas to NLNG, because SNEPCO's sister company is a shareholder of 25.6% in NLNG. But the reason why it was easy to open this FID is because the prices of gas in the export parity market is better than the price of gas in domestic market. In domestic market, the government has what they call the national reference quote that basically caps the calculation of domestic base price of gas to GBIs. And with the national reference quote, you have gas prices at anywhere around $2.13 for power generation and $2.48 for other GBIs, other gas-based industries. And then you have NMDPRA pipeline transportation regulation fee of about $1.13. So the prices are cheaper, and then operators feel like
to
the
go
prices
on
are
a break.
not
You've done very well giving us some
affordable.
perspective and giving us insight into the details of this deal. Yes, we stand to benefit a lot. It's tied away from crude. It addresses the shortage issue. And yes, you have commended the government, but you're saying that there's a lot more that needs to be done. We'll get into that a lot more in just a moment after the break. Stay with us. All right, a landmark as Shell invests just even more into the gas sector. And obviously, when the investment is ripe, obviously by 2030, it's believed that it will address our gas shortages. And it's being done in a sustainable way, according to our analyst, Kelvin Emmanuel, who is with us now. Thank you for your time.
Thanks for having me.
Yes, yeah, you have provided quite a lot of detail before the break, but let's get a little deeper into it. Yes, it's addressing issues of shortages, and yes, it's also there's a commercial drive behind it, right? They want to make more money. It's to make Nigeria a gas powerhouse, and Shell is pursuing both exports as well as domestic energy goals with this investment, and it supports Nigeria's ambition to become a global gas powerhouse. But we know there's a balancing act that we hope to be achieved here, so we don't mirror what's happening with fertilizers, and that is reliability of Nigeria's LNG exports to global markets, and at the same time ensuring LPG is also adequately supplied for domestic use. So how can we ensure that while we're focusing on commercializing the sector, boosting exports, we're also ensuring that local self-sufficiency in terms of affordability and accessibility is also maintained?
A very interesting question you asked, and the reason why this is interesting is because this H1OM 144 is actually focused on the export markets, not on Nigerian markets. Even if the sections 108 of the Petroleum Industry Act provides for what they call domestic gas delivery obligations that are compulsory for operators to allot a share of their gas output to the domestic markets. The government, of course, gave a waiver on H1OM and 144 because it realizes that as a shareholder in NLNG JV, Train 1 to 6 and the coming Train 7 desperately needs gas feedstock. As a matter of fact, I'll tell you, 2020, Tavares, on behalf of Glencore and Vitol, paid for 19 cargoes, forward contracts. Because of gas shortage, feedstock, COVID, and then Russia-Ukraine war that started, there was a sudden reliance of dependency of LNG on other markets. Nigeria was one of the markets where Nigeria could not step up because crude oil production dipped to about 1,900,000 barrels, and that affected the output of associated gas. Well, NLNG defaulted. They went to court. Tavares won. Not a judgment debt. It was appealed. Tavares won the appeal in London, an arbitration court in London. So there's a judgment debt of $380 million because NLNG does not have enough gas feedstock to be able to meet up the obligations it has based on the commercial contract it has signed with off-takers. So you see, this particular FID is not meant for the domestic market. And like I said earlier, the reason why the domestic market will struggle with gas supply is because if you look at the current $4 trillion bond the president has approved to be paid to gas aggregators who supply power generation companies, you see that there's a problem with the partial risk guarantee that the World Bank structured that is used for paying gas aggregators that supply power generating companies in Nigeria. And one of the issues is the fact that the prices at which the government has capped gas or it buys gas from gas aggregators is too low, for the gas aggregators. You can imagine them selling at maybe $30.50, $30.65 per standard cubic feet when they can sell at $6 per standard cubic feet. Why would I want to do that? It doesn't make sense leaving money on the table. And which is the reason why I have urged NMDPRA as a regulator, Nigerian midstream and downstream petroleum regulatory agency, that they need, as part of their responsibility in the PIA, you look at sections 29 to 52 of the PIA, to come up with what they call a capability model that can model the prices of gas along the export parity markets. Nigeria is benchmarked to 3 export parity markets, Egypt, Saudi Arabia, Trinidad and Tobago, to see a forward curve and on an appropriate price for gas in domestic markets. If you don't do that, the operators will keep avoiding building infrastructure that is required to deliver gas, process gas, deliver gas to gas-based industries. Gas-based industries like Dangote. So, for example, Dangote is actually not buying gas at the prices for the domestic market, even if he's supposed to, because he's in the domestic market. He's paying an average of $5-6 per standard cubic feet for gas, which is what the export markets are paying. Power generation companies will struggle to get gas they need for their thermal plants, generate power, and power is a major issue for industrialization and manufacturing in Nigeria and basically powering the economy. So, this is something that has to be done. For you to be able to get gas, you need to do this. As regards LPG, I'll tell you two things. Number one, if you don't get enough gas feedstock, because when you get gas to central processing facility, it's wet gas. It goes through treating and then separation. Separation takes it to methane. Methane is about 80% composition for natural gas. Methane is what is used to compress into LNG. And then you have ethane, you have propane, you have butane. Nigeria uses a blend of propane and butane, but uses more butane than propane. Your C4H10 and your C3H8 family, And the problem is if you don't get enough gas feedstock, both for LNG, for methane to compress the LNG, you won't also get feedstock for C3H8 or C4H10 to compress into LPG. So it's combined. On the refinery side, refiners produce LPG because when the RFCC, freezes crude and it dries the molecule and then it goes through a process of, separation and distillation. LPG is one of the derivatives that is trapped, recovered, in the refining process. If the refiner is struggling to get crude feedstock, for example, he says that, okay, maybe it makes more sense to, use that gas as propane to process into polypropylene, polyethylene crystals, petrochemical feedstock. And the refiner finds that it makes more business sense to sell polypropylene feedstock, PPL, PEL, PVC, because, there's a cartel in Nigeria that controls LPG, and they've decided that the prices at which they want to sell LPG is different from the prices at which the refiner is selling. The refiner is selling at 760 naira per kg. They are selling at average of 1,005 to, in some places, up to 2,000 and above per kg. If it doesn't make sense, he's going to convert that propane he's supposed to, supply the markets as LPG into petrochemical feedstock for PVL, PVC, and PPL. So these are the realities we have to face. And this is the job of the regulator.
So from what you're saying,
absent, the regulator is confused, he doesn't know what to do.
So from what you're saying, Kelvin, there's a lot more that needs to be done to ensure that all these investments remain commercially resilient, and you're putting that onus on the regulator. Since we're already downstream, let's stay downstream for a minute, and considering that this is the annual Downstream Week 2025. I believe you spoke in Abuja just yesterday. We had Nigeria's House of Representatives. They announced plans to introduce the Refinery Protection and Promotion Bill. What can you tell us about this proposition, and how do you think it can potentially reform the sector the more?
Thank you. I believe this is my last question, Joanna.
One more.
Yeah. Well, my message to the National Assembly yesterday when I spoke about the government-owned refineries is that the NNPC is leading them astray. It's sunk cost fallacy. The idea to keep doing the same thing in the same way and expect to get a different result is what they call a definition of being insane. You've had these refineries since 1965. The last one was commissioned in 1989. First of all, the yield, when you look at your crack spread, refiners have what they call crack spread. The yield for PMS is about 18%, not even up to 20%. Dangote is in 54% because of the efficiency and because it's a new refinery. the refinery is outdated. Most of the EPCs were inflated. Most of the parts have been demobilized. It's not a going concern. And I said, listen, between 2019 and 2025, the NNPC, got $2.96 billion in loans for 1.45 for Port Harcourt, 210,000 barrels capacity per day, $898 million for Warri, about $586 million for Kaduna Refinery. If those monies were actually put together, right, and they were used to build a brand new refinery in Port Harcourt, brand new, right, that refinery today will be producing 5 million liters of PMS, and it will be a competition to Dangote. So the question I had for them at the annual downstream week, and NNPC officials were there too, the regulators and UPRS and MDPR. The question I had for them is, why don't you use these monies you're sinking into old moribund assets into actually building a brand new refinery? Does it make sense that in the last 25 years, the government has used $18 billion to do turnaround maintenance, not to build a brand new refinery, turnaround maintenance, and Dangote spent 8 years building 650,000 barrels capacity refinery that is, shaking and disrupting the entire supply chain globally? Yeah. Does it make sense that you continue sinking in money and saying that, we've spent so much money already, if we don't put in more money, we'll lose what we've already spent, which is called sunk cost fallacy? Does it make sense? So the attempt to put together a refinery protection bill is political. It won't go anywhere. It is a waste of time. The National Assembly are not telling themselves the truth, and I said the truth to power. So it's left for them to, if they want to continue in the old path that has not led us anywhere, or allow the private sector to run business.
All right.
Because the government over time has not shown that it has a capacity to do business.
Interesting thoughts there. We'll see how far this proposed bill goes. But again, we do appreciate your thoughts and your time on the show today. Kelvin Emmanuel, CEO, Derry Hills.
Thank you, Joanna.